What's up, guys? I hope you're doing well. We're just continuing going on with the monetary policy report that was published this past February from the Federal Reserve. This one, we're going to look at some charts pertaining to like business investment and stuff like that. So also like imports and exports and various things. So let's just go ahead and get started. Go to the screen share here. We go. You guys got that? Yeah, I'll do this. So it's a little bit bigger for you guys. Okay, so basically, investment in equipment and intangibles grew at an annual rate of just 4% in the second half of last year, a marked step down from the nearly 14% pace in the first half. Um, so ultimately, the pace of the business investment slowed down. Or well, investment and intangibles. I don't know, or equipment and intangibles, which we see down here in the graph. It's this black line. You can see it kind of not really flatline, but definitely see that the slope is different coming from uh, the second half of 2021. And these are reported quarterly, I believe. Yeah. Okay, so investment in non residential structures declined further last year despite a sharp rebound in oil drilling and remains well below pre pandemic levels. This sector typically lags in recoveries, and shortages of building materials may be further restraining activity. Um, so, structures is this blue line, so like business investment in various structures, um, including like oil drilling. And so you see, before the pandemic, it was up here at around 2,200, and this is in billions of dollars. Um, and even at the end of 2021, it's not even up. That's still what 600 below, which is we'll say around a third. So it's like a 33% decrease still, right? Somewhere in there. Quick math, going from 22 to below 1600. Um, and structures, so they're not. It's like still barely above that in which like 2010ish. So it says they typically lag in recoveries, which seems pretty obvious, I guess, especially when you look at equipment and intangibles, how it's increasing, whereas structures is still going down. And again, they bring up building materials, which we know is still a problem, or at least was still a problem. So, oh, sorry, I read that wrong. Um, the structures, this blue line is on the left axis, so it's actually went from we'll go $575 billion down to $450 billion. Looked at the wrong axis. Um, that's still like 25% or 20 to 25% below what it normally or what it was before everything. Um, Corporate financing conditions through capital markets remained broadly accommodative for non financial firms and continued to be supported by corporate bond yields that remain very low by historical standards. Um, I mean, we've been in it's like a 40-year bear market in terms of bond yields, which is, I mean, that's nothing new. Obviously, it's a trend that's happened for 40 years. Interest rates have been, in general, going down. Um, Throughout that entire like historical trend. So yeah, amid these low yields and ample investor demand, gross issuance of corporate bonds continued at a robust pace, albeit down from the exceptional pace seen in 2020. In contrast, bank lending to business was on net subdued last year. So banks aren't lending to businesses, at least as much, apparently. And so businesses are having to. It seems okay. So it seems like banks are not lending to businesses as much, and so that means that the corporations are having to basically issue debt in order to get funding. Um, they also bring up PPP right here, which I didn't highlight. So there's also the government transfer payments to businesses and stuff that were a factor. But still, we know that like corporate debt is at an all-time high, or at least was. We're still around that era, and so yeah, they're having to go to regular people, or at least funding debt in other ways than just typical loans. Um, meanwhile, financing condition. Oh my God. Meanwhile, financing conditions for small businesses have improved notably over the past year and have generally been stable in recent months. Lending standards have eased, and loan origination volumes are in line with pre pandemic levels, though loan demand remains weak for the smallest firms. Moreover, default and delinquency rates are now within their pre pandemic range. So, when it says default and delinquency rates, they're now within range, but I didn't see anything that pertained to like whether they were above the range or below the range, because and I'm not really sure what the difference would be, or like how to differentiate that without actually searching for the data, which I just haven't found yet. Because I mean, with everything that's been going on, I would you would expect it to be higher, and it came back down into the range. But with all the government involvement and stuff like that with the PPP, there was something else. I think it was like household delinquencies and like mortgages and stuff because of the mortgage forbearance and stuff like that, to where basically the delinquency rates were a lot lower than they used to be in normal times. So not sure if it was either above or below the range, but now we know they're within the range. So whatever that means. So high levels of imported goods have kept international logistics channels operating under high pressure, which has continued to impair the timely delivery of goods to U.S. customers. By contrast, U.S. exports increased modestly over the second half of 2021 and remain below pre-pandemic levels, which we see here in this chart. Um, One thing to note is that imports, there's only one axis on this one, so they're both to this right one. Um, I mean, y-axis at least. And so you see, um, Jesus Christ, quit blowing up my phone. Took care of that. But imports are always above exports, at least from 2007. So means we're a net importer. And one thing to note is the spread between them has been widening as well. Um, Maybe not quite so much in the latter half of 2021. Without getting actual numbers, it's hard to tell whether this difference would have increased. But you can definitely see here from 2020 to at least the middle of 2021, imports increased a lot faster than exports after its initial drop because in March 2020. Which makes sense because everyone was staying home and stuff like that. So that we know that production of various goods and services basically went offline. And so we had to get them from somewhere. And so we imported them because people still need to eat. We still need energy and stuff like that. And if we're not producing it, it has to come from somewhere. And so it came from other countries. And then U.S. trading current account balances. Which we see is basically they have like the same trend. They follow each other well. To be completely honest, I don't quite remember what current account, but the U.S. current account is. So obviously something with trade. I guess I can look it up because I don't remember what exactly it is. Current account. It reflects the combined balances of trade in goods and services and income flows between U.S. residents and residents of other countries. Okay, so yeah, it's basically a way to show trade, which would make complete sense. So I guess like the spread would be the difference in like between whether or not it's foreign or domestic, like where the income's flowing. And this is a percent of nominal GDP, and well, the entire graph is below the zero axis. So I guess is this a trick? So yeah, I'll have to look more into this one because I'm not entirely sure what I'm looking at, to be honest. That's kind of the whole point of these videos and stuff, is to kind of do it not necessarily on the fly. As you can see, I went through and highlighted stuff, so you're not just sitting here watching me read it. But I did it once over, reading it, and then highlighted stuff, and then kind of did it. And the whole point is to try to figure it out, kind of on the fly. So yeah, I'll have to look more into this one because I don't want you guys just sitting here watching me read, because I'm not entirely too sure. But yeah, that's one of the that's the end of this one. There we go. But that's kind of the point of these videos, right? Is for me to kind of learn on the fly, and you guys can watch, and just kind of see and learn together, I guess, and talk about it. So that's pretty much it for this video. And so I hope you guys have a good night, and see you guys on the next video.